buy some land, buy some cows, milk them twice a day, sell the milk, repeat forever. That's the picture most people carry around in their heads when they think about dairy farming. The safe business, the boring business, almost old-fashioned in how simple it sounds. A slow machine that just prints money, one bucket at a time, decade after decade. Stick around. Because by the end of this video, you're going to understand why a 59-year-old farmer in Iowa stood there and watched, silently, as his 700-acre farm got sold off in a courtroom. And he hadn't done anything wrong. He'd done almost everything right. Here's the twist, and it comes early because it has to. Dairy farming might be the only business on earth where the exact same asset that makes you money is also the asset that traps you in losing it. You can't sell half a cow to raise quick cash when things get tight. You can't quietly downsize for a season and wait for prices to recover. And walking away, it turns out, often costs more than staying and bleeding. Keep that sentence in your back pocket. We're coming back to it. So what does it actually cost to walk through that door in the first place? Start with the herd. 50 cows, decent breed quality, and you're already looking at $50,000 to $200,000 before you've built a single thing for them to live in. Add a barn and a modern milking parlor, and you're on the hook for another $150,000 to $400,000. Add it up, and you've spent roughly what most people pay for a very nice house. Except this house eats every day, gets sick without warning, and needs partial replacement every few years, whether you're ready or not. And that's the small end of the range. Push towards something built for real throughput, call it 250 head, and first-year startup costs can climb close to $1 million. More than half of that is the herd alone, four-legged capital that just happens to also be alive. The milking system sized for that many cows adds another $180,000 on top, and that's before a single gallon has been sold to anyone. Here's the part nobody quite budgets for. The bills don't stop once the doors are open. A modest 20-cow starter herd alone eats through $16,000 to $30,000 a year in feed. Insurance, tax on another $2,000 to $12,000 annually, just to protect what's already sunk into the ground. Now here's a number that should worry you more than any of the ones we just covered. In 1978, the average dairy herd in Wisconsin was 36 cows. Today it's pushing 200. That didn't happen because farmers suddenly wanted bigger herds for the fun of it. It happened because the economics quietly stopped working at the old size. The barrier to entry didn't just rise over the decades, it moved, permanently, further away from where an ordinary person can actually reach it. So land, herd, buildings, feed, insurance, none of that, on its own, is really the point. The point is what you're actually buying underneath all of it. You're not buying a business you can pause for a year or scale down quietly while you wait out a bad market. You're buying a herd of living, breathing, depreciating assets that need to eat and be milked every single day, whether the price that morning makes any financial sense at all or not. Now that you've paid to get in, let's talk about what you're actually selling. Because here's where most people's understanding of this business runs out completely. They think there's one product, milk. There isn't. There are at least 5 separate income streams stacked on top of each other, and most farms are only using 2 or 3 of them. Layer 1, the obvious one, raw milk, sold by the hundredweight, 100 pounds, priced as a single unit, abbreviated CWT in the trade. This is the foundation, and it's also the most violent layer by far. In 2014, milk hit a historic high of more than $26 per hundredweight, driven largely by a buying spree out of China. Farmers were euphoric that year. Then the bottom fell out. Same cow, same milk. A completely different paycheck, sometimes within the same 12 months. If your entire business rests on layer 1 alone, you're not really running a farm. You're running a bet, and you don't get to pick when the odds turn against you. Layer 2 is the one almost nobody outside the industry has ever heard of. Milk isn't paid for as a flat commodity the way most people assume. It's paid for by component, specifically the butterfat and protein content inside it. Two farms selling the exact same volume of milk can walk away with two very different checks, because one herd's genetics and feed program are quietly producing richer milk than the other. This is the layer that rewards patience over luck. You can't fix component pricing overnight. You breed for it and feed for it and wait years to see the number move. It's slow money. But it's money the market can't crash out from under you the same brutal way it crashes the raw price. Layer 3. The cattle themselves once they've aged out of milking. Culled cows go to beef. Calves go into breeding programs or the beef supply chain. This is the quiet secondary market almost no shopper standing in a grocery aisle ever thinks about. Every dairy farm is also, whether it advertises the fact or not, a cattle business. It rarely makes the headline number on a balance sheet, but on a farm running thin margins, this layer is often the whole difference between a break-even year and a losing one. Some operators go a step further and specialize in genetics outright, selling embryos and breeding stock to other farms trying to climb that same component pricing ladder we just talked about. One farm's slow, patient breeding program becomes another farm's shortcut. Layer 4. Direct-to-consumer and value-added products. Cheese, yogurt, on-farm sales. Agritourism. Farms that process even a slice of their own milk into a finished product get to keep retail margin instead of settling for commodity margin. Selling a wheel of cheese for $30 is a fundamentally different economic proposition than selling the raw milk that went into it for a few cents a pound. The catch, and there's always a catch, is that this layer takes capital, time, and a set of marketing skills that most dairy operators never actually signed up to develop. It's real revenue. It's also, quietly, a second and completely different business bolted onto the first one. And now, Layer 5. The one that's actually going to surprise you. Manure. Specifically, the methane trapped inside it. Run manure through an anaerobic digester and you get biogas. Burn that for electricity, or upgrade it into renewable natural gas, and you've turned a waste disposal headache into a revenue line. In California, the low-carbon fuel standard will pay up to $200 per ton of methane avoided. Stack electricity sales, avoided utility costs, and carbon credit income together, and a well-built digester on a large enough herd can pull in hundreds of thousands of dollars a year. Hundreds of thousands. From the exact thing every other business on the planet pays money to haul away. But here's the catch, and it's a brutal one once you sit with it. Industry consultants put the threshold at roughly 3,000 cows before a digester makes any financial sense at all. Below that number, you simply don't produce enough manure to justify the equipment. So the exact same waste stream that's a cost on a 200-cow family farm becomes a profit center on a 3,000-cow industrial operation. Same manure, same methane, wildly different economics purely because of scale. That's not a footnote. That's the entire shape of the modern dairy industry, hiding inside a single revenue layer. Small farms are locked out of the newest, fastest-growing income stream in the whole business, not because they're doing anything wrong, but simply because they were never big enough to walk through that particular door. Line up all 5 layers and a pattern starts to show itself. The base layer, raw milk, is the one every single farm has access to, and it also happens to be the most volatile, least controllable layer in the entire business. Every layer above it demands either years of patient breeding, a second business's worth of capital and skill, or a herd size that most operators will never reach. The farms actually thriving in this industry aren't necessarily the ones milking the most cows. They're the ones who've climbed furthest up that stack. And the ones still stuck down on layer 1, alone, are the ones most exposed to whatever happens next. Which brings us to the part of this business nobody puts in the brochure. Go back to what we said at the very start. A dairy herd isn't something you can pause. It's not something you can quietly scale down for a year while you wait for better prices to come back around. A cow doesn't stop eating because the market turned against you. Milk or you financed doesn't stop costing money because you'd rather wait this one out. Every asset in this business is sunk, biological, and illiquid, which sounds like a dry technical detail right up until you see what it actually does to a farmer's decision-making. Economists at Cornell ran the actual numbers on this, and the result is almost cruel in how precise it is. For a 500-cow operation, the milk price needs to reach $17.52 per hundredweight before entering the business makes financial sense. Fair enough, that's just a threshold. But the price has to fall all the way down to $10.84 before it makes sense to exit. Read that gap again. Somewhere between $10.84 and $17.52, a farmer is losing real measurable money, and staying in is still the rational choice, because shutting down and selling off sunk assets costs even more than losing money while you keep going. It gets worse the smaller the operation gets. A 50-cow farm needs milk at $23.71 just to justify getting in. But the exit price for that same small farm is only $13.48. The smaller you are, the wider the dead zone stretches, meaning the farmers with the thinnest cushion are the ones locked into losses the longest. Why does exiting cost so much more than entering in the first place? Because entering only requires you to buy assets. Exiting requires you to sell them fast into a market that knows exactly how desperate you are. A barn built for 250 cows isn't worth much to anyone who doesn't want to milk 250 cows. Specialized equipment gets auctioned for a fraction of what it cost new. And the herd itself, the thing you spent $50,000 to $200,000 building, has to be sold into a beef and breeding market that has no obligation to pay dairy prices for it. Every dollar you spent getting in was spent building something specific. Getting out means unwinding all of that specificity, usually at the worst possible moment, to the least sympathetic buyer in the room. And here's why that single mechanism doesn't just hurt one farm at a time. It hurts the entire industry, all at once, through a domino effect almost nobody outside of it ever sees coming. When milk prices drop, the textbook response is simple enough. Less profitable producers should leave, supply falls, and prices recover on their own. That's how markets are supposed to self-correct. Dairy doesn't work that way, because farmers can't actually leave. They're stuck in that dead zone between entry price and exit price. So they keep milking, not because it's smart, but because it's less bad than the alternative sitting in front of them. And when everyone keeps producing at a loss instead of walking away, supply never really falls. Prices stay low longer than they should. The correction that's supposed to happen simply doesn't happen. Not until somebody runs out of cash entirely. It wasn't a hypothetical either. Over an 18-month stretch, more than 2,700 dairy farms went out of business in the United States. Here's the detail that makes it worse. This wasn't purely a story of collapsing prices. Raw milk costs were actually climbing during much of that same stretch. The trap didn't only catch farmers on the way down. It caught them on the way up too, squeezed at the same time by rising costs and a market too jammed with trapped producers to let prices breathe. So this is the real shape of dairy farming, sitting underneath the calm surface we opened with. It's not simply a volatile commodity business the way people assume when they picture something like wheat or corn. It's a business where the exit door itself is priced against you, where the very asset generating your income is the thing bricking you into a loss you can see coming from a mile away and still can't escape. And if you think that's only a small farm problem, something that happens to family operations without the scale to compete, you're about to see the exact same trap catch the biggest players in the entire industry too. Let's start small. Let's start human. Iowa, late 2019. A farmer named Kurtenbach, 59 years old, was running a 500-cow dairy operation on a farm just shy of 700 acres. When the math stopped working, He did exactly what a smart operator is supposed to do. He pivoted. He sold his 500 dairy cows to a family out in California and converted his barns to feed cattle instead, raising them to 600 pounds before shipping them off to feedlots in Nebraska and Colorado. It still wasn't enough. He needed one more investor, worth $600,000, just to keep the farm standing. He didn't find one. On December 15th, he watched, in silence, as his farm was sold off in bankruptcy court. He wasn't an outlier having one bad year. In Iowa alone, farm bankruptcies more than doubled between 2018 and 2019, from 13 filings to 27, and that was despite the federal government pouring $1.58 billion into Iowa farmers that same year to offset losses from an entirely unrelated trade dispute with China. Government aid and a genuinely smart pivot, and it still wasn't enough to beat a structural trap. And Kurtenbach's farm wasn't sold to sit empty. Land freed up by a closing dairy operation almost never stays idle for long. It gets absorbed by whichever neighboring operation is big enough to keep expanding, which is exactly how you get from an average herd of 36 cows in 1978 to nearly 200 today. Every farm that goes under in a bankruptcy court doesn't just disappear. It quietly becomes somebody else's growth. Now zoom all the way out. Because the exact same mechanism that took down a 500-cow family operation in Iowa also took down two of the largest dairy companies in the country, within 2 months of each other. Dean Foods, America's biggest milk processor. In 2017, the company posted $61.6 million in profit. 1 year later, that number wasn't just gone. It had flipped into a loss of $327.4 million. Read that swing again. From $61 million in profit to over $327 million in losses in a single year. By November of 2019, Dean Foods filed for Chapter 11 bankruptcy and needed $850 million in emergency financing just to keep the lights on while it searched for a buyer. 2 months later, almost to the day, Borden Dairy followed it into bankruptcy court. This was a company 163 years old enough that its cow mascot had been smiling out from milk cartons for more than 80 of those years. Borden reported losses of $42.4 million in 2019 and listed debts between $100 million and $500 million owed to more than 5,000 creditors. Here's the detail that really stings. The raw milk Borden had to buy from farmers had risen 27% that same year. They were being squeezed from both directions at once, rising costs on one side, a market too crowded with trapped producers to let retail prices climb fast enough on the other. Two companies, 163 years and 100 years of combined history between them, both gone within 2 months of each other, caught by the same dead zone between entry price and exit price that took down a family farm in Iowa. That's the real shape of this trap. It doesn't care how big you are. It doesn't care whether you're a 59-year-old with 700 acres or a Dallas-based company with 14,000 employees on the payroll. The mechanism is identical at every scale, an asset too illiquid to walk away from, a cost structure too rigid to shrink fast enough, and a market that keeps punishing everyone for staying exactly as long as it punishes them for having entered in the first place. Kurtenbach found a genuine workaround, a real pivot, and it still wasn't enough. Dean Foods and Borden had 100 years of brand equity between them, and it still wasn't enough. If the trap can catch operators with those kinds of resources behind them, the real question isn't who's vulnerable to it, it's who isn't. So where does all of this leave you, if you're actually the one standing at that gate, deciding whether to walk through it? Best case, you're not just milking cows, you're running a stack. Component pricing optimized through years of careful breeding. A herd large enough, 3,000 head or more, to make a methane digester pencil out. Turning manure into a genuine second income stream instead of a cost you quietly bury every month. maybe a cheese operation or a farm store capturing retail margin instead of settling for commodity margin. That farm isn't really a dairy farm anymore, not in the old sense. It's a small industrial company that happens to produce milk as one of several products rolling off the line. Worst case is far more common and, honestly, far more painful to look at directly. A mid-sized family operation, too big to survive on the charm and thin margins of direct-to-consumer sales, too small to ever touch digester economics or the component premiums that actually move the needle, permanently exposed to layer one and nothing else. Permanently parked in that dead zone between entry price and exit price, where leaving costs more than losing. But here's a twist that even a lot of people inside the industry haven't fully caught on to yet. Some farmers have stopped fighting the trap and started using it instead. A 2017 tax provision lets capital gains get discharged as debt inside a specific kind of bankruptcy filing, and dairy farmers who understand it are walking away from their operations with up to $228,000 more than they'd have made, simply selling the farm outright. The very mechanism that was built to punish farmers who couldn't leave is now, for a small and clever few, the cleanest exit ramp in the entire business. The trap didn't disappear. Somebody just found the one door built quietly into the wall. So the next time someone tells you dairy farming is the safe, boring business, the one where you just buy some land, buy some cows, and let the money show up twice a day like clockwork, remember Kurtenbach standing silent in that courtroom in December. Remember Dean Foods and Borden, gone within 2 months of each other after 163 years and 100 years of history. This industry was never really selling milk. It was selling the illusion that you could leave whenever you wanted,